Good evening. Welcome to Investing in Real Estate with IRAs 101. I'm David Priest with Paratus Commercial Group. I'm located here in Houston, Texas. I'm primarily a capital raiser for multifamily projects here in Houston. I've got Paul Herbis here with Equity Trust. He is the expert on IRAs and is going to give us some tips, tactics, strategies, shortcuts to wealth. And we're also going to talk about 1031 tonight. Paul, why don't you give an introduction of your background and what you do?
Yeah. Thank you very much, David, first for this opportunity. Yeah, really appreciate it. My name is Paul Herbis. I'm an employee here of Equity Institutional Services, uh, a company belonging to Equity Trust Company. I specialize in self-directed IRAs and 1031 exchanges. So really excited to speak with you guys tonight about what investors have been doing for decades and really what savvy investors have been doing since the 70s when we're talking about self-directed IRAs and the ERISA Act. Yeah, very excited to cover how we can avoid donating to the IRS and rather use those funds to reinvest into real estate.
Yeah, so delay, defer, or deny. That's the name of the game. Taxes, I learned that from an accountant. Delay, defer, deny. So
Yes.
if you can do that, we all want to avoid the tax man until they say the inevitable is death and taxes. If you can delay them beyond death, you won that game. So let's
Mhm.
get started. Also, too, a little bit of a shameless plug here. My wife has a self-directed IRA with Equity Trust, and we've been very, very happy, and it's helped us to do a lot of passive investing and invest in our own deals. And our relationship and the service we've gotten from them has been very, very good. So I just wanted to let you know that I'm a customer, I'm a client, so I'm giving them a full endorsement. So Paul, go ahead. Let's go dig
Yeah,
into it, what you have, and let's learn a little bit. And I'm looking forward to learning about this.
wonderful. So as I mentioned, guys, we're going to learn how we can stop donating needlessly to the government and rather how we can build and preserve wealth through those self-directed IRAs and 1031 exchanges. I want to talk a little bit about us here at Equity Institutional Services first before we dive in to IRAs. Also want to cover checkbook IRAs as well. Want to make sure you guys have your options when it comes to going ahead and creating that wealth and preserving it. Then want to shift gears to 1031 exchanges and talk about strategies and most importantly, want to open it up to a Q&A session hereafter just to ensure that we spend some time having a discussion about self-directed IRAs and 1031 exchanges. At the end of my presentation is when we'll open it up to questions. We'll make sure to provide you guys my contact information as well. Yeah, to make sure you guys can get a hold of me after this if you have any follow-up questions or any questions you'd prefer to take in a one-on-one setting. Um, so a little bit about us here at Equity Institutional Services, formerly Midland Trust. So we were acquired in 2023 by Equity Trust Company. We were previously flying underneath the Midland Trust Company flag and under the Midland 1031 Exchange flag. One of the big reasons that I believe we were acquired was due to our 1031 exchange business. Equity Trust was looking to horizontally integrate their business. They had already been deferring capital gains taxes and IRAs for 51 years, but they were looking for a way to do it outside of retirement accounts as well, and that being through a 1031 exchange in regards to real interest in real property. Another prong into which I believe we were acquired was our relationships with general partners and with limited partners alike, and with those in the syndication industry. Prior to that acquisition, we were actually recognized by Forbes Advisor as being the best custodian to work with when it comes to private equity investments. Certainly something we know very well. A little bit about us. We have four different offices. The beautiful office you'll see here on the screen is going to be located in Cleveland, Ohio, where most of our associates will reside. I myself find myself in Sioux Falls, South Dakota, which is where we're chartered with the South Dakota Division of Banking. We also have offices in Fort Myers, Florida, and then east of Willis Tower in the Loop in Chicago as well. A little bit about us. This slide is slightly dated. We currently have $57 billion under custody as compared to that 45. And we do have over 300,000 account holders and 400 different associates. Currently, we do over 2 million transactions in any given year. So what is a self-directed IRA, guys? A self-directed IRA is a marketing term. It's a fancy buzzword to draw an investor's attention. What it really speaks to is the administrator and custodian that you are using to go ahead and place that investment. A lot of those larger custodians that you'll typically see on a Super Bowl halftime show, think Charles Schwab, Fidelity, JP Morgan, T. Rowe Price, the list goes on and on. Those are going to be your traditional custodians where you're going to go ahead, get invested into a mutual fund, a stock, an S&P 500, an index fund, an ETF, or a bond, right? Typically a very traditional investment. Those institutions will not allow you to self-direct your retirement funds. And that is actually where we built our business model as of the past 51 years, is servicing that market of investors who are looking to self-direct their retirement funds and invest in offerings like private equity, who are looking to break away from the returns seen on the stock market and invest into a deal that they believe in that could certainly generate a higher return in a passive setting. What do most of our investors typically use an IRA to invest into? Most invest in real estate. So when it comes to real estate, either real estate syndication or real estate property, that encompassing private equity. We also work with hedge funds as well. We work with those who use their retirement funds to trade futures, commodities, and as well as foreign exchange, private notes, and many, many more. The only thing you're not able to use your retirement funds to invest into are going to be two items, one being life insurance and the second one being S corporation stock. Anything outside of that, you're allowed to go ahead and invest in. Now, there are some rules when it comes to investing with your IRA that we're certainly going to get to later that are important to be aware of when making those respective investments. A self-directed IRA custodian is needed to place those alternative investments, or at least to create that IRA to ensure you're compliant with the IRS regulations. Most custodians will only allow those public markets. We are in a very niche industry as a custodian. There are a few players in our industry, but it really is a very niche industry because many investors don't know they can self-direct their retirement funds. I often refer to it as the best kept secret in the finance world. Not once did I learn about this in my undergraduate or my master's courses. Sure, they talk about IRAs. Yes, they talk about 401ks. They most definitely do. But not once do they mention you can self-direct it. And it really opens up a lot of doors when it comes to investing and when it comes to liquidity. It allows people to go ahead and really invest in those deals they're passionate about rather than have some money manager make a percentage over their funds. These clients don't know where they're invested, what they're invested into, or who they're invested with. And those are many different areas that they don't have answers to. So it gives people a sense of control and really allows them those unlimited choices. Now, what are the advantages, Paul, of using a self-directed IRA? And this would be the first advantage I'd ask all of you to write down. No capital gains taxes. Huge advantage when it comes to the world of investing. My goodness. To the point where I'll work with individuals who, even after age 59 and a half, why is age 59 and a half special? Well, it's when you can start taking those retirement funds without the early penalty. I'll work with those who even have funds that they can go ahead and take distributions on, but rather elect to use their self-directed IRA because they're not paying capital gains taxes on the returns of those investments. They want to mitigate their taxes. It's not about how much you make. It's about how much you can keep, right? I mean, a tale as old as time. Investment options. Many options are unlocked once when you have that self-directed IRA. It's going to let you invest into the world of alternative assets like a real estate syndication. Administrative fees are going to be much lower when it comes to self-directing your assets. You're not going to be paying for those assets under management like you would at a traditional firm. We have flat fixed fees. Our investors will typically pay $555 their first year and $350 annually thereafter. Very affordable when it comes to investment. And that's whether you invest 50 grand or 5 million. You're still going to have those same rates. So we like to be easy when it comes to flat fixed fees. And then true diversification. I mean, my goodness, this is a wonderful way to take all your eggs out of one basket because for most investors in America, they're all sitting in one basket, and that's called the stock market. And as soon as that thing starts to crash and that balloon starts to deflate, America feels it. right? America as a nation feels it, especially those who have been contributing to 401ks for 40 years. Maybe you're a titan of industry. Maybe you're a banker, you're a lawyer, you're a practicing dentist, what have you. Um, People's pockets feel it when we go through those times of stress on Wall Street. So it's a great way to start moving some of those eggs out of that Wall Street basket and start moving them into the world of private equity to where you can be well diversified and not just sitting in these traditional assets. Job changes are going to be one of the most common reasons we'll see people open up self-directed IRAs is because they can then get access to their retirement funds. So when it comes to going ahead and funding that account, we're going to get into account types in a little bit, but it's important to know that once when you leave your employer, say I have a 401k, say I'm with a previous employer, I'm now able to go ahead after I separate from them and roll those funds over into a self-directed IRA. Active employers typically will not allow for this. Exceptions can be made. They're known as in-service rollovers to where you can access those funds. Typically the exception, not the norm. Illiquidity is one of the greatest reasons as well that these investors will go ahead and use their retirement funds to get invested into a syndication. Maybe they are already invested into multiple syndications with their personal funds. Well, here's a great way that they could still be liquid and still go ahead and make that investment. Or maybe they want to hold on to personal funds because of economic uncertainty or the like. Well, here's a way you could still go ahead, invest funds, see the returns that you want to see while mitigating those taxes and while remaining liquid. It is a wonderful solution. Tax mitigation, of course, applies to those capital gains that we were speaking of earlier. Now, Paul, what type of accounts can actually be used? Many different accounts can be used to go ahead and invest into real estate. One being a 457B as well as a 403B. A 457 is going to be for state or local authorities. Think of an elected official, a mayor, right? A 403B would most commonly be seen by those working for 503C non-for-profits, as well as those working for religious institutions like a church. Everybody typically knows what a 401k is. Most common type of retirement vehicle. You'll be contributing to that typically with a match from an employer. And then a thrift savings plan is going to be reserved for those uniformed service members who are going to be serving in our armed forces. Switching gears here to IRAs, there are many different types of IRAs that you could go ahead and use to invest. Traditional IRA is going to be one that's going to have a pre-tax status. What does that mean? It means once when you start taking those funds later in life, they're going to get taxed as ordinary income. So with a traditional IRA, it's important, especially later in life when required minimum distributions start occurring at age 73. What's a required minimum distribution? Well, it's when Uncle Sam says, all right, you have to start taking some of these funds so I can start seeing some of my tax money. It's important when entering age 73, even before entering age 73, to start creating a plan in regards to those distributions, to start working with your CPA accordingly, to make sure that you're taking those distributions on time and that they're not bumping you up into another tax bracket when it comes to your ordinary income. For both traditional and Roths, a contribution limit would be $7,000 currently here in 2025. It is $8,000 if you turn 50 or you're older than 50 in this calendar year. A Roth IRA is going to be post-tax in status, meaning you've already paid taxes on those funds you're investing. The great thing about a Roth IRA is when you take those funds out at 59.5, they're tax-free. It's a wonderful way to create compounding interest in the absence of taxation. It is a wonderful tool that has created many wealthy Americans. A Roth IRA also is going to be different than a traditional IRA in that you're actually able to take tax-free and penalty-free withdrawals after 5 years. So it's also a way where you can remain semi-liquid too. So it really is a wonderful tool when it comes to investing. I want to speak to the Roth IRA as well here in the modified adjusted gross income limit. So there is an income limit for a Roth IRA, $146,000 if you're single. If you're filing jointly, it's $230,000. That has been really done away since 2010 when a backdoor Roth conversion came to be. Well, how do I overcome this, Paul? I open up a traditional account, I fund the traditional account, I pay taxes on that money, and I convert it to a Roth status. It's a wonderful way to go ahead and get through that loophole. A SEP IRA, that's going to be a simplified employee pension plan. It's going to be for any size business. The downside to a SEP, only business owners can contribute. Contributions that are going to be maxed out at 25% of the salary, or $66,000, whichever is going to be lesser. And then that simple IRA, the savings incentive match plan for employees, much more attractive plan, and then employees can actually contribute as well, but it's going to be limited for businesses of 100 employees or less, and those contributions are going to be maxed at $16,000 or $19,500 if you're age 50 or older and have that contribution limit. Still many other accounts that you can invest with as well. An HSA, a health savings account, is another one that you could go ahead and actually self-direct. Most people don't know, but you can use an HSA to invest into real estate. It's also going to have that pre-tax basis like the traditional IRA. It depends which type of HSA plan you have, whether it's a family plan, which is going to be I believe $7,750, or a self plan, which is going to be, I believe, just below $4,000 at $3,850. So it will determine how much you can contribute depending on the type of HSA you open, but certainly a way you could go ahead and still make those contributions and investments, as well as an ESA. A covered adult education savings account is another great way that you could go ahead and invest. That's going to have a post-tax status very similar to that Roth IRA. With contributions for those being maxed out at $2,000 for those 18 or younger. And exceptions are made for the age if there are any special needs circumstances or anything like that. And then inherited IRAs as well. What's an inherited IRA, Paul? Well, it's something you inherit when somebody passes. Those have a little more gimmicky rules to them in that you have to distribute all funds in 10 years if it's a non-spouse account. And then solo 401ks as well are another option that you could actually use to invest, but are going to be reserved for those individuals who don't have any common law employees. So who do I see typically use those? A practicing attorney, dentist, somebody who owns a business practice that doesn't employ anybody outside their spouse. But what are some tips and considerations? What are things you need to keep in mind when investing with that self-directed IRA? The investment's made in the name of your IRA. It's not actually yourself who's investing. So say I go ahead and invest into a syndication deal with my IRA. It's not Paul Herbis that's investing. It's Equity Trust Company as custodian for benefit of Paul Herbis, account number 12345. So very, very important to understand that IRA custodian is legally the holder of it. And ultimately, all funds will need to flow to and from that retirement account. Really important to annotate that as well. There can't be a commingling of funds. Ultimately, it's going to be that IRA's investment, and ultimately, it'll be that IRA's return. Typically, it'll take around 2 to 3 weeks to go ahead and set up an investment in regards to establishing the self-directed IRA, funding it, investing it. That would be for a 401k rollover. That would include for a check and a 5-day check hold. If you're going to be doing an IRA to IRA transfer, much more seamless process. We're looking at 1 to 2 weeks there. And as I mentioned earlier, active 401k money typically off the table. It's still worth asking the question, though, and that's something I encourage everybody to do. If you have an active 401k and you're not sure if you can self-direct it, ask your plan administrator if you can perform an in-service rollover. The worst they're going to tell you is no. You're going to be exactly where you were at before you ask the question. It's worth having the conversation. 3 easy steps to invest: open the account, fund the account, make the investment. Fairly seamless. Now, I want to shift gears here to a checkbook IRA. Now, a checkbook IRA isn't a special type of IRA. It's an IRA like any other. But what it is it's an IRA that owns an LLC, where that IRA is the sole member and where that LLC is managed by that account holder. It allows them limited liability protection to go ahead and typically is used for real estate property to limit liability is the biggest reason. Say there's a tenant in the property, your IRA owns it. You want to limit your liability, as would anybody running a real estate operation. So it's a great way to get that LLC protection as well as to have transaction speed. You're able to actually have an account established in the name of your LLC where you can make all payments from that IRA and have all funds from that IRA go to. So you're in much more of the driver's seat when it comes to IRA investing. Now, this is a lift that we certainly can assist with. It is not required that we create the LLC. It's certainly something that you could do if you have a real estate attorney you trust or who is very knowledgeable in checkbook IRAs, but it will need to be a new LLC. It cannot be an existing LLC. It will need to be a new LLC. We can help assist in the creation of it, the articles of organization, the operating agreement, the EIN, initial state filing, bank account establishment, and now the beneficial ownership form. I saw today actually that came out that will be upheld. So the beneficial ownership form is actually a part of that LLC too that will need to get addressed. And we would also assist in establishing that bank account with our trusted partner at Titan Bank. I recently found out actually this last week that another custodian that does checkbook IRAs also uses Titan Bank, which made me feel wonderful because they've been doing it for decades. They're a great partner, and certainly someone that a lot of custodians turn to for that checkbook IRA bank account establishment. Now, here is what that structure is going to completely look like. Ultimately, funds are going to be moved from your current institution over to ours, where we could assist with the creation of that single member LLC. Funds would be moved from then our institution to the bank account of that LLC to where you could invest into real estate as you see fit. Now, an important consideration to call out here when using checkbook IRAs or any self-directed IRA for that matter is disqualified persons. Now, who is a disqualified person? A disqualified person in my IRA would be myself, my spouse, my lineal ancestors, so my parents and grandparents, and then any of my lineal descendants as well. So my children, my grandkids, as well as their marriages. So my daughter-in-law, my son-in-law, all the way down that line, right? Now, what does this mean? This means I can't purchase something for myself personally. Say I, Paul Herbis, owned an acreage of land personally in my name or in my LLC's name, let's say, for example, personally held, has nothing to do with my retirement funds. Say I want to purchase that land with my retirement funds, I'm not able to because it would be a straw hold deal. I would just be moving funds from my IRA into my bank account, and then my IRA would own it. I'm not allowed to do that. What I could do is I could invest alongside my IRA as a tenant in common. That's something I could do. I could pool those funds together, but I'm not actually allowed to purchase items from myself. That bleeds right into the second point here. Self-dealing is certainly something that you want to be aware of. The handling of funds, very, very important to ensure no commingling is happening. With that bank account, you are not able to use it for personal use, nor are you able to put personal cash in there. Really important to ensure there's a distinction. What could occur if you were to do so? You would have an early distribution. Your IRA account would not be an IRA account anymore. You'd be forced to take all of that as personal cash, and you would be hit on the head with any applicable early distribution fees and penalties from the IRS. Certainly something we all want to avoid. How can I avoid that? Well, I can ensure I'm not transacting with any of those direct parties we mentioned earlier, and I can ensure I'm not commingling funds. How do I do that? I keep a ledger, and I have an active awareness of what I'm investing into, as I'm sure all you are surely aware of the investments you're making. But yeah, keeping that ledger using those bank statements from Titan Bank are certainly important. I know I went through the structure in terms of how to create the LLC. Really as easy as opening up the self-directed IRA, establishing that first. We can actually help you form that LLC in conjunction while we're waiting from funds from your current custodian. After we have that LLC off the ground and after we receive funds, we then move it to your LLC to where you can invest as you best see fit. Now switching gears to 1031 exchanges, something else I'm very, very passionate about, which actually comes from the Internal Revenue Section Code 1031. And it was a tax provision that's been around here for over 60 years, actually over 70 years now. And it's a tax deferred strategy used by real estate investors to defer those capital gains taxes when replacing into property. We're going to cover 5 basic rules here that are very important to 1031 exchanges and something that you need to keep in mind when making these investments. The first one is well, Paul, how much do I need to reinvest? It's a question I get time and time again when it comes to 1031 exchanges. That magic number is going to be the net selling price. At the end of the day, that's really what we're going to be looking at. That's going to be that gross selling price less any of those commission costs, title costs, any of those miscellaneous expenses that come up during closing, you're able to subtract from what you had sold that property for. That's the number that you need to reinvest. That's the number that you need to purchase a new property for, or purchase multiple properties that add up to that in aggregate to defer the full amount of capital gains taxes from your original sale. Real property. This is a common misconception when it comes to 1031 guys is like kind. What is like kind? It's an investment property. Full stop. I can move from acreage, undeveloped raw land to multifamily. I can move from multifamily to single family. I can move from industrial to mixed use. I mean, the list goes on and on. And once upon a time, you could move from real estate actually in 1031 into a private jet. They've done away with that now, but certainly something you once were able to do. I mean, even something you could reinvest into is a 30-year lease on a cell phone tower on a cell phone tower. I mean, there are many creative ways to structure these, but you need to ensure you have a real interest in real property. At the end of the day, that's what the IRS is looking for. Now, what is a qualified intermediary? It's what we are here at Equity 1031 Exchange. It is what you need to complete that 1031 exchange, and it's going to be that independent, unbiased party that's going to govern it and that's going to handle the escrow of funds to ensure everything's above board. Who can it be? It can't be a lot of people. It can't be the taxpayer doing the exchange, can't be the agent, the realtor, the attorney, tax advisor, banker, anybody that has a relationship with that taxpayer and is an advisor to them is not able to be that qualified intermediary, which is why so many people go ahead and turn to us to complete their exchange. It is a very unregulated industry, which is something I want to call out as well. There are many fly-by-night crews, one-man bands out there that go ahead and do these that are unregulated. So it's really important you're doing your due diligence when you're looking for a qualified intermediary. I cannot advise that enough. What are the time limits, Paul? What are the rules? What do I need to be following when doing this? Need to follow timelines. Timelines are very important. The first one being a 45-day rule, which is going to be your identification period. It's going to be the time into which you can identify a property, and it starts when you close on a property. So say I go ahead, I want to sell my property. I close today, the 45-day window starts. After that 45-day window, I'm not able to identify any other properties that I want to replace into. And there are a few different rules that you can elect to use when going through this 45-day period. The first one being the 3-property rule. It is the most commonly used by far. I can name any 3 properties regardless of their fair market value, but only 3. And those are going to be the ones I list. Or you could use a 200% rule, which means I could list any amount of properties I want to. So I could certainly list more than 3, but the aggregate of all those properties combined cannot exceed 200% of the value of the property I'm selling. So say I'm selling $1 million property, I can list as many properties as I want, so much as they don't all add up to 2 million or over. So that's what the 200% rule is. The 180-day rule is the timeline you have to complete the exchange. Exactly 100 days. No ifs, ands, or buts. Doesn't matter if it falls on Christmas, Easter, New Year's. Does not matter. The IRS does not care, nor do they have any empathy nor pity. So really ensuring that we're following that 6-month period very stringently. This is a question I get asked almost every single week. Do vacation properties qualify? The answer is yes. Yes, they do. So this differs greatly from a self-directed IRA investment. With a self-directed IRA investment for property, I'm not able to personally use it or benefit from it. With a 1031, I can. Now, the property must be rented at least 2 years before its sale and after it's purchased, but I can use it 14 days or 10% or lesser. So a lot of people will go ahead, replace into a single-family home, into a very nice vacationable area. They'll go ahead, Airbnb, verbo it out, or just get somebody leased in there, and then we'll still use the property, not infrequently, but they'll still take advantage of it with their loved ones. Some important considerations to keep in mind: how the property is deeded from the sale is how the property needs to be deeded at the acquisition. The IRS wants to make sure it's the same taxpayer. That's really how it's structured. So whether it's in the name of your trust, really important to acquire in the name of the trust. In the name of an LLC, really important to acquire in the name of an LLC. And then in your personal name, you're acquiring in your personal name. Now these can change. Typically, we'll see people wait that 2-year seasoning time period. They'll then quick claim deed it to their LLC and or maybe move it into their trust at that time. Um, you're not able to 1031 exchange your primary residence. Needs to be an investment property, and the exchange needs to be placed in prior to closing. I cannot tell you how many heartbreaking investors have reached out the day after their closing to give me a call saying, "Paul, I'm ready to do the 1031 exchange. I closed on my property yesterday." Well, I'm so sorry, Mr. John Doe. Unfortunately, we wouldn't be able to assist. You're not able to unwind after that. So this needs to be something that's set up prior to closing. Very important. Now, what are the types of exchanges? Standard's going to be the most common one by far. I sell first, I replace after. We would escrow funds. So we would go ahead, ultimately be that escrow agent for you. We would work with that closing entity, whether it be an attorney or title company, to go ahead and work on that settlement statement. Really, we would become involved in the process after that client would have a contract for sale. Is really when we would begin that process, working with that closing entity to go ahead and ensure we can get this 1031 stood up. Once when they're moving to replace, the client would then also go ahead, send us that contract for purchase then to where we would go ahead, work with the closing entity, prepare the settlement statement, go ahead, proceed to wire funds from escrow, and ultimately get that taxpayer closed. A reverse exchange is going to be a lot different. I've highlighted the key differences here just to catch your guys' eyes. A single member LLC is going to be set up. So that's really how a reverse exchange is going to differ, because in a reverse exchange, I'm actually going to acquire first and I'm going to sell my property after the fact. So how are we able to accomplish that? With an EAT, which is an exchange accommodation title holder, a single member LLC taking title to the property that you're actually originally purchasing. Now that EAT is something that we would go ahead and hold in your stead, and ultimately would be something we would fully assign to you after your sale has been completed, allowing for this exchange to be above board. Typically, that reverse exchange is a great strategy to be used if you're concerned about that 45-day time period, because at the end of the day, you already know what you want to sell. I mean, typically most investors know exactly the property they're looking to unload. The reverse exchange really buys you time. And that's something that it truly does, is it takes the pressure off that 45-day identification period and really gives that investor much more time, so they're not rushing into any deal. So they're not rushing into any penciling, and to ensure that they're replacing into the property and they're making the investment they want to make. An improvement exchange is a very interesting type of exchange, and one where you can actually use proceeds from your sale to go ahead and improve property that you're acquiring. Now, there are more moving parts to this one. In an improvement exchange, you actually need to identify the work you're going to be doing beforehand and the approximate value of each of those improvements. Well, Paul, when do I see improvement exchange used? I see them used by savvy real estate investors, typically by developers. I see a lot of developers use this as a way to go ahead and improve properties that they're investing into. A big thing about an improvement exchange as well, all work needs to be completed by the 180th day. Only the work completed by that 180th day will actually qualify towards the exchange. So really important to be aware of that when you're going ahead, when you're making that exchange. Because at the end of the day, you want to ensure you're deferring all those capital gains taxes. You want to ensure you're making those improvements, and they can be such a wide range of improvements. We've seen people add in pools because they're looking to go ahead and and spend some capital and not pay the IRS, but rather improve their property and the value of it. So, yeah, certainly a wide array of things it could be used for. Now, diving into a little bit of strategies here, we'll see this used for people looking ahead and to get into cash flowing properties. I mean, I'll see many different farm families and farmland actually rolled into other ventures. I mean, if your guys' family is anything like mine, which is a very large farm family from both sides, you're going to commonly see this used. One, to acquire property with greater cash flow. Two, to take advantage of a stepped up basis. So with that 1031 exchange, your heirs actually aren't going to pay that capital gains tax when you go ahead and when you pass away. So it is a really great way to preserve the generational wealth that a lot of investors have worked hard and risked much to obtain. So it is a really great way to take advantage of that stepped up basis and ensure your heirs aren't paying those capital gains taxes either. Also a wonderful way to consolidate or diversify. For people looking ahead, I'll typically see people who have a larger single family portfolio. Say they have five or six rentals that they're currently managing, but say it's getting a little stressful for them. Maybe they have a W-2 as well. Maybe they're practicing in another form or fashion, and they don't have the bandwidth to go ahead and manage all those properties. Great way to consolidate into some multifamily. I'll see a lot of people go ahead, do that, hire out a property manager, take care of their headache. I typically won't see it used as much in this bottom scenario where people are getting out of multifamily into single family, but I certainly will see it very much so used here in the former rather than the latter. And then to acquire less management intense property. For people who are sunsetting, who may be getting older in life, who may be looking away to step away from actively managing real estate, a really great way to go ahead and get into raw land as well. And then to move markets. I mean, this is this is something I really saw in 21 and 2022. Were people looking to go ahead and get into deals and find great places that pencil. A lot of people, I mean, the day and age we live, everything's just a jet ride away. Everything's a plane ride away. Whether that be 5 or 6 hours, it can be made into a day trip in this day and age, truly, whether you're flying commercial or private. So I saw many investors these past few years go ahead, move from properties that maybe they've held or their family has held for quite some time and get into areas to where they could see a greater return. Also, I've seen this used to get out of non-landlord friendly states and into landlord friendly states as well. I've very much so seen this used in the past 365 actually, to go ahead and to relocate into better states to do commerce at. Now, I want to make sure we open it up here for a Q&A. I want to make sure I can get some questions answered and be a reliable resource for everyone here.
Yeah, fantastic. If you have some questions, please put them in a Q&A. Everybody should have access to that, so you can type them, and then I'll read them. And I got a few comments. One thing you mentioned on the 1031s and using a respectable institution. I heard a horror story. I'm not going to use any name the person it's happened to. It's a very well-known person in the real estate business, really big in our business. He's in the Northeast. They were doing a 1031. This is like years ago. And you may have heard this story, Paul. I don't know. And the circle can be kind of small. He had met this guy at a conference. Yeah, we do 1031s. It's great. And so they sold the first property and they had the money in escrow, $750,000. And it turned out this 1031 guy, it's not regulated, was kind of using the 1031 money and shuffling it around and not putting it in escrow. And he was kind of running a Ponzi scheme. So eventually they were buying the other property and they needed their 750 back. And they said, hey, we need to find this guy. And they started calling him and they couldn't find the guy for a few days. So finally, this person said, well, let's hire a private detective. We got to find this guy because he's not returning our phone calls. He's got $750,000 over cash. We got to find this guy. And the private detective called back like a day later and said, hey, I'm going to send you a news story. This guy's deceased. I mean, somebody had killed this guy in his car and burned his car out. I guess he ripped off the wrong person, or, it was like in the Northeast. So I don't know. There could have been other things involved. But the sad part of it for my friend was the 750 was gone. They could not recover it. And he said what he had to do was he had to go sell some of his single families because he had some old single families to make himself liquid. He said, I couldn't just tell my investors I'd lost money. He's a stand-up guy. He replaced all of it. But he said, I lost $750,000 on that deal, and I had to replace investor money because I didn't use a qualified institution. And, I was trying to save a few bucks here, and I met a guy, and he seemed like a nice guy. And so based on that like horror story, not to be too morbid, basically, yeah, if you're going to do a 1031, use an institution. Don't go cheap on your fees. Don't try to, this is not a time to be clipping coupons because when you sell that first property, you're going to have to give them all the money from that sale to hold until you find the other property for many months. And if you
Right.
got any doubt if they're going to be a trustworthy escrow agent, you need to be really careful on that.
Couldn't
So,
agree more.
one thing too you mentioned that was really interesting was also on, people getting out of the business and exiting and going to land. I really never heard of that, but yeah, you could sell your multifamily properties 1031 into land. So it's like a store of value. There's no management. And then if your children inherit it, they don't need to manage the land. But if they decide to sell the land, they got the stepped up basis on the capital gain. So it's kind of like a buy, borrow, die. So it allows you to get
Mhm.
out of your active management into passive. And you can also do the same thing on syndications. And we don't do as many 1031s on syndications. I think it's starting to come back. Me and Paul had talked about this. Usually the bar is pretty high. They want a lot of money because it's like a lot, it's kind of a hassle. If you're doing 50, 100,000 more typical retail, they don't do that. But I think it's going to start coming back, especially with bonus depreciation. If it doesn't come back at 100%, the syndicators in multifamily have been living off bonus depreciation and taking deals and doubling people's money using a 50% cut, using 100% bonus depreciation, just going and doing bigger deals and moving the money around. So
Yep.
we don't see as much of that in syndication. Another question I get is on a syndication, why do I have to use a self-directed IRA? Why can't I just use that? And the reason is in syndications, they're not registered securities. So one
Mhm.
of the things that I was surprised by when my wife and I started investing was that when I go into equity trust, if I click real estate, I'm clicking the wrong button. I mean, syndications are private equity. You're buying shares in a private equity investment and not real estate. So that was a real surprise for me. But it does fit into my model. Like in multifamily, we're not buying a real estate piece of real estate. We're buying a business.
That's it.
So, and that's just the way they look at it. You're buying shares in a business. The real estate is just where the business is located. And when we do renovations or better management, we're just trying to improve the business so we can improve the value of it. So I'm going to
Mhm.
look at some of these like questions. I'm going to read them, and then I'm going to let Paul answer them unless I have some kind of an input, which will probably be minimal. So let me read this. So Arlette says to me, missed at the beginning, but can you explain if a 60-year-old would be able to set up a self-directed IRA and still be able to invest in real estate?
Very
I'm,
much so.
yeah. Yeah, there's
Yep.
not an age limit. You might have minimum distributions, but there's no age limit when you're looking at investing. You can move the money over at any time. And doing it early is better. And a lot of times, people will have a 401k at their company, but then they have an IRA on the side. They may have put some money when they were younger and it grew. And those are really good to roll over because you don't have to ask for anyone's permission and it kind of gets you
Mhm.
going. Okay. Andy has a 1031 question. I've done 3 standard 1031 exchanges. What are your fees for the standard exchange and reverse exchange?
Great question. So our standard exchange is going to start at 1295, and that reverse and improvement is going to start at 6500. Well, Paul, why is the reverse improvement so much more expensive? It's a much heavier lift for us. So we have to go ahead, establish that exchange accommodation title holder, and then if an improvement, I mean, work with you on those specific improvements, ensuring we have all that documentation. Um, but they're fairly standard fees. I mean, most qualified intermediaries will charge anywhere from $1,000 to $2,000, anywhere in between for a standard. And then with that reverse, I mean, I'll typically see, I mean, anywhere in the neighborhood of even 7,500 by a lot of firms. Um, but as David mentioned before, um, when it comes to shopping price for a 1031 exchange, that might not be the place where you want to do it. We're talking about deferring tens, if not hundreds of thousands of dollars in capital gains taxes, and an investor wants to make sure that's done right. I mean, at
Yeah,
the
I
end of
mean,
the day,
I'm just looking at the math. If you have $100,000 in a syndication, you double rates 200, you get $100,000 gain. The capital gains rate, if it's 20%, I mean, that's 20
right.
grand right there. So if you're trying to avoid the 20 grand, the 1295 is, I mean, if I give you 1295, you give me 20,000, I'll do that all day long. That's a pretty
Yeah.
good, I like that trade.
But
So
but we differ. I mean, we differ from other
Right.
qualified intermediaries. We have two qualified exchange specialists on staff, so not one but two. Most entities don't even have one. Well, what's a qualified exchange specialist? It's somebody who's been through rigorous exams, and that's upheld with the code of ethics too.
Yeah.
So we got
So,
we got plenty of intelligent, honorable
so
people.
Ray's got a question about the typical fee to turn a 401k into a self-directed 401k, but he may mean a self-directed IRA because you can go 401k to IRA if it's
Yep.
closed out. I think if you're doing like a self-directed 401k would be more of like an active investor that wants to invest their own money actively and kind of be like
Right.
a general partner. I think if you're doing a 401k, it's more self-directed, like a self-directed IRA. That's what we did. Like my wife, a lot of her IRA
Right.
is self-directed, is a 401k. She rolled over to a regular IRA, and then we moved the money, back and forth to the regular one. So I think that is more typical. If I remember right on ours with Equity Trust, it was about $1,000.
So
And
we're
a lot of
at
people.
at Equity Institutional, we actually beat our parent company's fees too. So we'll take care of you, Ray. $555 is what our clients typically will see in a first year spend, and then $350 per asset they're invested in annually. So flat fixed.
Yeah, yeah. So I mean, it is very, very good as far as rolling it over. This service has been really good. So you can roll that 401k, and I think it's a little sad that people that are in the company and they're still employed, they can't segment out some of their 401k and roll it. And like I said, you might want to, if you're in that situation where you have a lot of money in a 401k and you want to try to roll some of it to a self-directed IRA, you might want to ask your employer. Another way to do it, and they're probably going to say no, I think there's a lot of rules against it. You might want to ask them about rolling it to your own IRA if you have an IRA. And then once you get in your IRA, you've got the money and you can go the self-directed route. I think that doing it that way is probably a better way. Hey, I need control of my money. I've got an emergency here. I've got a family problem. I got a health issue. I need to access this money fast. I want to say I've got 500,000 in my 401k. I want to put 100,000 in my own IRA so I have quick access to it. You ask and they segment some of it out. And then once it's in your IRA, it's out of their hands and you can kind of do whatever you want with it. And then you can roll it in the self-directed. So it's one of those things, if you don't ask, you'll never get that answer, but it's worth it to ask, especially if you work somewhere a long time and you have a plausible reason why you might need access to it and you're in good standing with your company. So you might just try that. Try that. One thing I've learned too with companies are getting things done, like what makes people really move is basically, I'll say something like, I was having lunch with my attorney the other day and I mentioned this. He wanted me to ask if that was even possible. He thought there might be a way to do it. You mentioned the word attorney. Everybody always just kind of seems like, wow, it's miracles start happening. Don't threaten to sue anybody, but it's interesting when you say the word attorney, all of a sudden, like there's a lot of action and things start moving and it gets people off their butts. So it's a good thing to ask. So we've got another person asking if they're using a self-directed IRA to invest in multifamily syndications. Can you take depreciation on investment property, or does it have to be after tax money?
Good question. Good question. So it's the IRA investing. The IRA is going to be the one investing. So I wouldn't be able to personally take advantage of depreciation if my IRA were to invest in it, um, which in effect means not every real estate deal will be perfectly paired for a self-directed IRA. And I'll be the first one to tell you that if it's a heavily incentivized, tax advantaged opportunity, which some are, and you're really looking at that investment as a way to personally offset your taxes, maybe a self-directed IRA isn't the best fit for that investment.
Yeah, the thing is too, if you're a passive, you typically can't use the depreciation to get your active income anyway. So we
Right.
give you the negative K1, it builds up, and then in the future, when you have a big exit, then you can draw off that bank and hopefully try to offset, and then we can go try to buy another deal and try to offset, and it gets really complicated. Basically, when you're doing self-directed IRA in a passive investment, you're not really using the depreciation, but you don't really need it because you don't have any taxes. And most operating agreements that I've seen, and every syndication is different, they will say that depreciation is going to be allocated to people who can actually take advantage of it.
Mm.
So if you have a investment with a lot of self-directed IRAs and you're not a self-directed IRA, you may get more depreciation. So talk to your sponsor about that. Your mileage may vary, but a lot of operating agreements, they don't, that money just doesn't go away. They say, we've got a pool. We're going to figure out what ownership percentage is in that pool. And then they try to direct the depreciation where it can be used. The beautiful thing about the self-directed IRA, though, is you're exempt from capital gains. And it doesn't matter if you're a real estate professional, a passive investor. So like what we've used it for is we've used it for our passive investments. We've got passive investments we do. And we really like that because we're not really worried about the depreciation on this because it's in the IRA. Also, it's a way of taking advantage of the fact that a lot of people, we're programmed to do 401ks and stuff when you're young, and we get these matches and there's all kinds of advantages to it. And then you get a lot of money that's trapped, Another question I get sometimes is, well, why aren't your syndication, why is it a registered security? Why can't I just use my regular IRA? And the thing is, the government, like if you want to register security, it takes 6 to 8 months.
Yeah, talk about red tape. My goodness.
Yeah, so when we're closing on a multi,
the deal's not there.
We got a 90-day window. No one's going to say, hey, we need 8 months so we can go register this security. So that's why we're not trying to skirt the law. We get an exemption. It's just the timing doesn't work. I mean, you got to close as quick as possible. If you've got to extend these deals out, they start charging thousands of dollars per day on the closing to extend it. So we can't wait for a registered security. So we go to a securities attorney, we get an exemption. So I hope that answers some of your questions. Arlette has another question, also being Canadian. We don't have 1031 exchanges. They don't have a 1031 in Canada, nothing like that. Does a marketplace or exchange exist to be able to find people who need to find a property? Are you raising capital for fun? How can we find active 1031 participants? Do many people are interested in syndications? I think like in a syndication, you really have to it's the person has to shop around and see what's out there. They've got to report 3 within 45 days. So you got to go find syndications that'll do 1031s, and not everyone will. And you got to make sure they'll work with a dollar amount you're dealing with. And what I've seen is, the minimums are pretty high. They're 3, 4, 500,000. I've seen one that's 250, but I mean, they're generally $400,000 or $500,000. So it's for people that are either high rollers, or it's for people that have a lot of money. Now, I have seen a deal where someone sold a bunch of single families, and they pulled that money together and went and did a 1031 into a multifamily syndication. And you can do that, but you have to make sure that your syndicator or your sponsor will accept that money. So there's a little bit of research involved. So you got to look around and find deals. And so if you're going to do this, you're selling a property or you're exiting a syndication, you need to start doing research and looking at being on a lot of people's lists. Or you can call somebody like me and I can tell you how to get on. I'm on everyone's list. I get like 100 emails a day. They're like deals. So you've got to, there's not like a marketplace or exchange like marketing. There's not like, hey, let's have a chat room where we've got all these people trying to place, or maybe there is. I'm not aware of it.
The closest thing to it is Bigger Pockets.
Bigger Pockets. Yeah, you maybe do a post. I'm looking for a 1031.
Right.
Yeah.
But no, as you mentioned, David, I mean, those big players, they want to see at least $250,000.
Yeah, I saw one recently. It was like they wanted a minimum of 400,000. Well, there's very few. Like my people, if my people typically put $100,000 in them, I work mainly with retail investors, and if we exit deal and they have 400 coming out, they're going to be super happy. But the bar is really high because of the 1031 and the way it works, and they're really kind of saying, hey, we don't want to deal with these problems unless you're kind of like a heavy hitter and there's a lot of money involved. So it may be for a more experienced investor. That could change, though, because if you get less bonus depreciation and people are looking for a way to do it, it may start making more sense. I think in the past, they were just like, hey, if you did 200, you doubled your money. We're going to use 100% bonus depreciation. We'll give you a negative 200 K1 and you're good. There's no reason to even mess with this. So I think it's a tool that hasn't been used a lot, and I think it's going to be used more in the future, depending on the bonus depreciation. Also, if you can use it every once in a while, you can save your depreciation for other deals. You can't have too much depreciation. It's not possible. That you cannot have too much. It's like having a bank vault full of money. You can just pull out and use whenever you want. There's so much depreciation. Okay, so Ray has a question about how long is the turnaround time in turning into self-directed?
Yeah.
Like if you're going to set up an account and you're going to roll a 401k or an IRA or part of it into it, what's typical?
Yeah, so with that IRA to IRA transfer rate, I mean, we're looking at 1 to 2 week timeline. If you have Charles Schwab, it's going to be closer to that 1 week. Otherwise, it'll typically take a week and a half. If you're going to be doing a rollover, so if you're moving funds from that 403b, that 401k, that thrift savings plan, typically going to take 2 to 3 weeks. Why does it take 2 to 3 weeks? We have our own 5-day check hold. And the institution doing the rollover will actually send a check instead of a wire. And then once we receive the check, we'll need to hold it for 5 days before we can go ahead and send funds. So typically anywhere from a 2 to 3 week lead time, quicker if you have Schwab. They move quick. Love working with clients that have them. Yeah, good question, Ray.
I found, and like when my wife retired from oil and gas, we rolled a 401k into our own IRA. And that was a lot more tedious process. It was like 3, 4 weeks. I remember like, you got to turn it into cash and then they got to cut a check and they got to send it to
Yep.
your other company and then they've got to do it and they got to wait for the check to clear. And it was 3 or 4 weeks. And it was a lot of money because she had retired and we had 401k and retirement account. We did it all at the same time. And I was kind of laughing. I was like, hey, we're in all cash right now. We need to pray the market like gets obliterated because we're perfectly set. In case the market goes down, we're going to be fine. If the market's going to crash, let it crash now. But it was a long process. And if the market had really taken off, we would have missed out on a lot of gains. So I found from the employer to the IRA, that's going to be your longest thing. When we went from her IRA to equity trust, it was literally like a little bit more than a week to get it set up and get it funded. The biggest hangup was you've got to put the money in cash in your own IRA. It's got to be cash. And then you got to wait for it to settle. So if you're doing a trade, if it's like Vanguard or a brokerage house, you've got to wait for the trade to settle 3 or 4 days, and then you have to move it. If you try to move it before it settles, it's going to bounce back, and they're going to say, "Hey, this didn't settle yet, and we can't move it." Okay. Andy has a question about can you 1031 into a syndication deal as a GP? It would depend on the sponsor and if they would accept that. I would think it'd be easier probably to 1031 as an LP. Because I've never
I would
heard of
say
anyone
so
doing
too.
it, but it doesn't mean you couldn't. You couldn't.
They'll need to structure it tenancy in common, and the reason that they're looking for that 250, 300, 4,000, they're going to pay anywhere from 20 to 50 grand in attorney fees to get you into the deal. These syndications are paying an exorbitant amount of attorney fees to try to make everything work, and yeah, it'll be done typically as a tenancy in common. And David, I couldn't agree with you more. As time goes on, I think more and more syndicators are going to become more and more friendly to these opportunities if that investor is bringing a substantial amount of money.
Well, what I'm looking at is like capital, like a multifamily, it's getting tighter. It's a little bit harder to raise money in some
Yep.
cases. And so, yeah, they look at more options and they've got to look at, ways to tax advantage this. And
100%.
and why not make it easier for people and have them save money? And it is kind of a hassle. You got to remember a lot of syndicators, like their investor relations, it's run on a shoestring. They got like 400 investors and they got one lady or one guy trying to run the whole thing and they're overwhelmed. And if
An
they go on
exec
vacation, the whole thing is shut down.
an
So
executive
they're
assistant.
operating on shoestrings. They're understaffed. So you got to be aware of that. So I think you could do one. You'd have to set it up really in advance with a sponsor to 1031 into a syndication. And you'd also want it to be putting a lot of money in. Most time the sponsors will put in like 100,000 each. We're trying to stay liquid for future deals, but if you're going to put a lot of money into a deal, yeah, or you're trying to buy your way in. Dirk says, is it advantageous to do a self-directed IRA on an inherited IRA or just take the distribution and try to offset the taxes another way? Are there alternatives to this? This is something we talked about this morning. I have mixed feelings. You're going to take the inherited IRA and you don't want to like pay taxes all at once. You want to spread it out. One thing to remember is you're not paying the taxes. Unfortunately, the person that gave you that IRA, it's going to be taken out of their amount, their taxes. But the problem is if when you inherit the IRA and you've got a lot of money in there, if you go invest all of it, then you could triple or quadruple your tax problem going out 10 years, and you've got a ticking time bomb because after 10 years, you got to pull it all out. So there's, you could pull it out and invest some of it, you could leave some in there. You could self-direct some of it. I mean, it really, this is something to get some real professional advice on what's the better way to handle this from an accountant. Get a maybe a third party. What do you think about that, Paul?
Yeah, I mean it's what's that old saying? Six dozen and half the other. I forget how it goes, but I think it's a great way to defer capital gains taxes while investing along that journey. The thing is the time window. I mean, if it's a non-spouse account, you got 10 years to drain it. So you don't want to be in a liquid position at that time. You want to make sure you're liquid and that you drain it in that time. If you have 6+ years left before you need to liquidate, I would consider looking at investing with it. If you're up against the clock and you need to drain the account in the coming years, it's kind of harder to remain liquid in the world of alternative assets
And another way to look at it, though, is if you did do all of it in a self-directed IRA and you made investments, you would have a bigger tax bill, but you'd also have a lot more money to pay the taxes. You would earn the tax bill. You could outrun it. So I mean,
right.
like, let's say in multifamily you went through 2 cycles, we could quadruple your money. Technically, you double the first time, you double again, it's a quadruple. You've got a
Right.
lot more money, a lot more tax, but also you made a lot of money to pay the taxes and then
Mm.
maybe try to figure out some way to negate it. I don't know. Maybe you become a real estate professional and reinvest all the money, or you put it in oil and gas, or do some trick. I mean, you're deferring the problem, and like with accountants, what I've learned is if they're really good, they can make water run uphill. You just tell them what you do, and they tell you, go do this, go do that. We're going to set this up. You could do a deferred sales trust maybe or something. I mean, there's all kinds of crazy stuff out there. So,
Yeah.
I would get some professional advice, outside of like, I'm throwing ideas out and Paul's obviously got ideas. Maybe get
Yeah.
some professional advice. Like if you were in this situation, talk to an accountant. How would you handle it? But I mean, I can see both ways. I can see taking it out now, paying the taxes, and then the gains are out of the system, and you defer and you'd use the depreciation because you're outside of IRAs. The other way is like try to quadruple it. You got a massive tax problem, but you earned all the money to pay the taxes, and you
Right.
still have a lot more money than you started out with. If your quadruple becomes a triple because you had to pay some of the taxes. So there's no wrong answer. Just I would say get professional advice and maybe do half and half. Do both strategies. Take half and do one, pull it out, do some things, and then keep some of it in there, multiply it, and kind of spread it around and do both. Do a hybrid. Okay,
Yep.
another question: using self-directed IRAs, is there any scenario where 1031 is used to avoid UBIT? Can you use 1031s with an IRA to avoid UBIT?
You can. So you can partner tenancy in common. So, yep, you could use it. You can use an SDI array to use a 1031. It's the only reason it would be used would be to avoid UBIT. At that point, though, we're getting pretty redundant on deferring capital gains taxes. Have I seen it done before? Yes. Is it very common? No. Um, typically, those investments are going to be done independent of each other because at the end of the day, and what I would tell this attendee is while it's not about how much you earn, it's about how much you keep. It's also important to ensure that the tax tail is not wagging the investment dog.
Yeah,
So
yeah, yeah, and also too that you're if you're going out 10 years, let's say you're going 10 years, a lot could happen in 10 years.
there you
I
go.
mean, I don't want to be negative, and you could pass away in 10 years. You could be the person inherited could pass away, or something can happen that pushes it out another 10 years because another person inherits that IRA. So a lot can happen. So I mean, I think I can see both sides of it, but I mean, maybe it's always better to push it out as far as you can. Like, don't normally it's not good to volunteer like, hey, I'm going to have a taxable event, or I'm going to create an event where I'm going to send money to the IRS. So I can see it. I can kind of see it both ways. So Andy, going back to his question, he was
Yeah.
asking if he was a sponsor. So let's use me as an example. Let's say I'm in 3 GP deals I've done the last 6 or 7 months.
Yep.
I get to the end of the thing. I do a huge exit. Let's say I hit a home run. I made a bunch of money. Can I take that money and 1031 all that money into another deal? Another one
Was
of my
this
deals.
was this a fund or what was the mechanism for raising capital in this case?
Co-GP. So I'm a GP on a deal. I'm a
Yeah.
sponsor. Can I go?
Unfortunately,
Can I 1031 into my next deal?
You cannot, because you don't own a real interest in real property. You own shares. So that's really boiling back down to the fact that that fund's a business, right? That fund you're investing into a private equity business,
Yeah.
which is why we refer to it as PE. You're not investing into a piece of property. You're investing into a syndication, into a living, breathing entity. You're
Right.
not actually purchasing a piece of that land. It's a very common misconception. For a 1031 exchange, you need to have real interest in real property. Now, I'll take this in actually another direction. So, say for instance, I have a property I'm looking to replace into. Well, what's something that I could replace into? I could replace into something known as a Delaware statutory trust, which is a legal entity that allows investors to own real estate without being directly involved in management, but they still own a fraction of that real interest in real property. That would ultimately be kind of like the workaround, I guess you could say, for investing into.
Yeah, I've heard of like deferred sales trust too. You can put everything in a deferred sales trust. And you can spread it over time, so you don't have that big tax bill, or you can just you can just go pay the tax bill and deal with it. I mean, it's the thing is on
Right.
all these events when they're coming up, you got to you got to get accountant. You got to call somebody and find out, hey,
100,
I got this
100%.
problem coming up. What do I do? And you figure out what you're going to do before the event happens. So, like calling an accountant, it's like buying insurance before the crash, before somebody runs into you. Not to be negative, you don't go out and like have the car crash and then call your insurance and say, "Hey, I got a problem, or my car got hit. What do I do now? Do I have insurance for this?" You want to be prepared and be ahead of it, and maybe you want to work these things out, in advance. And I know people like I know sponsors that they'll come out of deals and have a big exit, which is great for everybody. It means your LPs did great, everybody did good, and they'll take some money and set aside for some living expenses. They'll save some money for their next deal. They can put money in another deal, and then they'll take the other money and they'll put it in somebody else's passive deal. So it's
Mhm.
working while they're not working. So I got some money to live on. I got a little savings. I got 100 or 200,000 for my next deal because I need to put money in my deals because that's an ethical
Yep.
thing I'm going to do. And then also I'm going to put money on the side to somebody else's deal because I want that money working when I'm not. And that's kind of my thing as I go along. My dream is to be 100% passive in 10 years and be the world's greatest passive investor. I mean, they're going to have it on my tombstone. David Priest, he was the world's greatest passive investor one day. But I just got to get to a point where I can have enough income, enough cash flow to be that world's greatest passive investor.
And partial exchanges are common too, David. So, I mean, if people are looking to not defer all the capital gains taxes, but say they do want to take some of those funds, use them to invest into a syndication deal, certainly something that I'll see as well. So,
Yeah,
um,
yeah.
partial
Or,
exchanges
or
are
you can take
certainly
the
on the
funds
table.
and you can get into another syndication or more
Hmm.
deals. Hey, I've got
Hmm.
money. I mean, it's real easy to partner in on a GP deal. If you bring in like $250,000, it's like real easy. I mean, no, you buy your way into any deal with that. Hey, I'm going to bring $250,000. Okay, great, you're in. Well, you'll be at the bottom of the list or whatever in some deals, but basically they'll let you in. So, any other questions? We've got Q&A here. Any other questions? Any thoughts, Paul? Anything we talked about? Anything that you want to reemphasize, or anything that these questions spurred that you want to discuss further?
Yeah, I had a thought, and that was a Roth conversion. So I don't think we spoke to that a ton. I know we spoke to backdoor conversions, but a great strategy for investors who possess youth. I mean, and even for those who are middle aged. I mean, if you're somebody who is, shoot, even for those who might be past middle age, if you believe that your income now is less than what it's going to be in the future, that's something you should consider. If you can comfortably take that tax burden in a calendar year, I mean, that is something serious to consider and something serious to have a conversation with your CPA about. Now, why? I've never heard of taxes going down. If somebody can show me different, I beg them to. I say this at every single speaking engagement event I am, and nobody's taken me up on it yet. No, nobody's informed me, but
Yeah,
I've never heard of
I
taxes going
wish
down.
I had done Ross when I was younger and done, the backdoor way of doing it or doing it. I thought it was great to take all the deductions now, And then I kind of figured out later on, it's like, oh, well, wait a second. Basically, if I'd gotten it in a Roth or used it outside the system, the capital gains rate is 20 to 24% in that range, depending
Mm,
on the tax bracket. But when you have regular income and you blow your 401k up and you've got seven figures or whatever, when you start pulling that out, they tax it at the absolutely highest
mm.
rate. It is the worst move you can take when you start getting it out. And I think people that are planning for retirement, they don't realize that they're taking
No.
money that could be taxed at lower rates and they're putting it in an environment where it can be taxed at higher rates.
Completely agree, David. And this SDIRA is a tool to help you unlock that 401k contribution you've been making for 20, 30, 40, 50 years. I mean, this is a way to tap back into those assets, to get them
Yeah.
out of to get them out of Wall Street and into the world of real estate.
Yeah, and there's a lot of people too that have old 401ks, like they've had three careers and there's old 401ks sitting around. And that I would highly encourage people to take those old ones and roll them into IRAs or do self-directed and you use this as something different. I'm not one of these real estate people that's like investing all in real estate, don't invest in the stock market. And there's people that do that. Now, there's people that do the stock market and, I'm afraid of real estate or whatever. I think it's good to do a balance of different things. One book I read recently, it's behind me. It's Tony Robbins, The Holy Grail. I'm not the biggest Tony Robbins fan. Uh, I think a lot of stuff he does is great. I mean, he kind of, it can be annoying sometimes. But that book is an excellent book. And one thing that was fascinating about it is if you look at people that are high net worth, and he grades high net worth as 30 million or above. So for me, that's like real high. I mean, that's like way high, but that's high net worth people. And he said that high net worth people above 30 million have an average exposure to the stock market and equities of 29%. So 29% of their money for people 30 million over is in the stock market. And if you look at people that are less wealthy, it's like 70, 80% when people, like you take a person that's a millionaire that's just seven figures. Okay, so the way to think about that are the people that have more money, are they smarter? Do they diversify more? Or, as Tony Robbins says, are they wealthier because they have less money in the stock market and they get better returns on private equity? So private equity requires more research, more due diligence. It requires more being proactive. But like he talks about in the book, the returns are a lot better. And a lot of people don't know about this stuff. And if you didn't know about this, you're just getting into real estate or syndications. I didn't know anything 3 years ago. I mean, I knew nothing. I've been in single family for 20 years, and I was introduced to syndications on vacation at a lunch. And the guy that was talking about it was from Brooklyn. He had a Newark accent. He was talking about syndications, and I thought he was like in the mafia or something. I had no idea what the guy was even talking about, and I had to start learning all this stuff. So if you're learning about this, that's okay. Don't feel like, oh, I don't know any of this stuff, because you weren't taught any of this stuff. We're taught basically to have a W-2 job, have a 401k, send the money to Wall Street, and they're hoping we don't learn anything outside of. You're told to have a financial planner because you're stupid, you can't learn all this stuff. So basically, we want to educate people about investing outside of Wall Street. It doesn't mean put all your money in real estate. It doesn't mean the stock market's going to crash. You got to sell everything, but you want to diversify. So if the
Mm.
stock market does crash, you're not going to be completely wiped out. And with real estate right now, a lot of real estate, like especially multifamily, it's on sale. It's down 30%. So I'm excited about that. If you want, I'll be doing a follow up on this call with an email. If anyone wants to talk about real estate or syndications, wants to book a call, right now I'd love to talk to people and educate them a little bit more. I do not have an active deal I'm raising money for. We're looking for deals. I'm really picky on my deal structure. So if you call me, I promise I won't try to pitch you a deal. I don't have one right now. And I would love to basically get to know all my investors better and talk to them about what their goals are so I can send you the right deal. And Paul, you put at the very beginning your contact information.
Yeah.
Okay. So can you repeat that? What's the best way for people to reach you? Phone
Yeah.
number, email address. So if they need to reach you, you can put it on the screen or you can just talk.
Yeah, the best way to reach me is my calendar. I live off my calendar. I put my Calendly in there. I love forming relationships too, David. I mean, I it fills my cup. It gives me energy. It's really the reason I'm involved here, and to give people their options. So if you're looking to learn more, if you have a bunch of questions, if you want to connect, I mean, I would encourage you to leverage my calendar. Otherwise, give me a call. That's my direct line right there. You can reach me via text, and then email as well would probably be my third mode of communication. I'll surely get back to you, but yeah, would love to do a Teams or a Zoom, and yeah, get to meet all you wonderful people, and yeah, make sure I can get you guys your options.
Yeah, and I'll definitely be calling, when I have questions because people ask questions about this stuff and I don't really know. But I do know with Equity Trust, the setup is really easy, so I can endorse them on that. And I went with kind of their standard setup. The institutional, these are like the A team. This is like the flying first class. And even they did, pretty good basically. So I will send a follow-up email. I will put Paul's information in the follow-up email. So if anybody needs to reach him, they can. With me, you can book on my calendar. The easiest way to go is go to LinkedIn, David R. Priest, and you can find me and you can book on my calendar directly from LinkedIn. You can always try to call me, 713-516-1207, or go to my website. So I want to thank everyone for being here. I think we filled all the questions up. We went a little over on our time, but it was an interesting conversation. And I'm going to go back and watch the recording because it's a little bit to digest. I mean, you put a lot of information out there, so I need to go back and watch this and digest it. I will send a recording out to everyone. I want to say thank you to Paul for presenting all this great information. If anyone has any questions, get in touch with him. I'll send his contact info out. If you miss it, call me. Most of you know me. You get a lot of calls and a lot of emails and stuff from me. But if you need me, you know how to reach me. And I want to thank everyone for being here and becoming more financially educated. And everyone have a wonderful evening, and hope to talk to all of you very, very soon.
Thanks, David.